I'm here with Kevin Pritchard of 4R Business Recovery, and in this video we're going to be discussing what is commonly referred to as Phoenix companies. Kevin, can you tell us a little bit more and explain the process?
Yes, Simon. A Phoenix company is a commercial entity that emerges from the failure of a previous limited company that's been subject to an insolvency process. The new company trades in a similar style to the old, now insolvent company, and it gives the appearance of business as usual for its clients and customers.
Is that legal?
Yes, Simon, it's perfectly legal. Shareholders and directors that have been subject to an insolvency process, like a creditor's voluntary liquidation or a compulsory winding up order, are entitled to form a new company. And in fact, HMRC and the Attorney General acknowledge it's perfectly legal to form a company from the remains of a failed business.
Okay, interesting. So are there any circumstances where the director of a failed company cannot be the director of a new company?
Any director, and in fact anybody, can be a director of the new limited company, unless they're subject to a disqualification order, they're a bankrupt, or they're subject to a bankruptcy restriction order.
So the question is, why do directors need a Phoenix company?
Well, the business has a value that's been built up over many years. The insolvency may be linked to a specific event, and the directors and the shareholders believe that they're in the best place to both protect jobs and take that business forward.
So, what would the role of the insolvency practitioner, or 4R, play?
In the majority of Phoenix startups, it involves purchasing the assets from the insolvency practitioner, or the liquidator, or even the official receiver from the old and now insolvent company. So assets can include stock, work in progress, patents, and intellectual property rights.
And we've seen this before.
Yes, in our previous video about creditors' voluntary liquidations, we discussed how it's often in the best interest of creditors to sell the asset, stock, work in progress to the previous management team because they understand the real value of those assets to their business.
So why then do Phoenix companies have such bad press?
The reason Phoenix companies suffer from such negative connotations is rogue directors get accused of transferring assets below their market value to the detriment of their trade creditors.
And some directors commit fraud.
Let's be clear, some directors do use the legal framework to defraud HMRC and their trade creditors. What's disappointing is if they'd taken proper professional advice, they could have asked us 4R. We could have given them a framework which would achieve the same result, but it would have been ethical, professional and lawful.
Now, Kevin, I know you wanted to talk about companies using the same trading name.
Yes, for obvious reasons, directors often want to preserve value by using the same trading name or the same trading style as the now insolvent company. For critics of Phoenix companies, this is the area that causes the most concern, because clearly a rogue director can use the same name, and that is confusing to consumers and potentially confusing to existing trade creditors.
And what about Section 216?
Section 216 is absolutely critical if a director intends to use the same trading name or style. It's an important piece of legislation that's intended to protect both them as directors, but also to protect the consumer and obviously trade creditors.
Kevin, for all of our viewers that are watching right now, what should they do next?
Well, for immediate help or just some impartial advice, call 4R Business Recovery and use the number that's on the screen now.